Hi, everybody. Good afternoon and welcome to Wealth Talks hosted by Victoria Mutual Wealth Management. It's the latest in this series of conversations with the objective of making you wealthy. This is a talk that we really need to be having right now. And I understand that over 600 people have registered for this webinar, by far the largest amount that has registered for the webinars so far. So we know that there is a lot of interest in this topic. My name is Kalila Reynolds, and I'm going to be taking you through the evening with our three exciting speakers and taking your questions as well. We also have some giveaways for you this evening, all aimed at making you more wealthy. Now, a little bit about myself and about this event. So if you don't know me, you ought to know me because I am the host of Money Mondays JA, Money Moves JA, and Taking Stock, all programs designed with the objective of making you wealthy. So I was very pleased a couple of weeks ago when VM Wealth Management reached out to me to host this forum because our energies are just aligning. There's this synergy. We have similar objectives. So if you're new to VM Management Wealth Talks, let me tell you a little bit about this event. It was created in 2019 as a quarterly forum to fulfill the mandate of providing information of relevance to VM's clients and members. And this is consistent with the approach of the Victoria Mutual Group, where education is a key cornerstone. VM Wealth Management covers investment related topics as well as discusses issues of importance to you, the audience. Now, these were face-to-face engagements in a which allowed social interactions after the session. But as you all know, COVID-19 has now made these face-to-face sessions turn online. We're still face-to-face. I'm still seeing you. You're still seeing me. And so previous sessions would have covered maximizing value from the stock market, budget overview, the government of Jamaica's budget overview, that big daunting number. Ooh, managing PEP and the transition to high school. So education matters were also covered, corporate finance strategies. But
Now,
that was muted. All right, I think you guys are hearing me again now. I think I was accidentally muted. So with the onset of COVID-19, VM Wealth Management has turned to digital channels in order to execute. So since March, topics discussed have been COVID-19's impact on investments, COVID strategies for businesses, coping strategies for children. And then this session about the stock market is aimed at providing investors with strategies for maximizing value from the stock market. So the aim of today's program is to educate the investing public by providing updates on key trends in US and Jamaican stock markets. Now, this is exciting. People ask me all the time about investing, not only in Jamaica, but investing in the US. So we have an expert in that market to share some knowledge with you. We also want to generate awareness of VM Wealth Management's US equities trading platforms. And that's another popular question. I have the knowledge of the market abroad, but how? How do I do it? VM Wealth Management has a platform for that. We'll be hearing all about it. We also want to generate awareness of VM Wealth Management's publications that are available to the public. We'll be hearing some more about that. We want to stimulate the interest of millennials in investing on the stock exchange. One of our guests is he still a millennial? Well, I guess he'll tell us. And we want to provide general investing guidelines and best practices. So before we get started with our guests, though, we'd like to kick off the evening with a giveaway. We have a few great reads that we'd love to share with you guys because knowledge is the start of wealth. Before you can get wealthy, you have to know how to get wealthy. And some of the books that we have on our giveaway list will help you in achieving that goal. So we're going to be giving away One Up on Wall Street, How to Use What You Already Know to Make Money in the Market. That book is by Peter Lynch. Here is a staple that should be in any investor's library, The Intelligent Investor, the definitive book on value investing, a book of practical counsel by Benjamin Graham. I recently did a video about that. And we also have Market Wizards Updated, interviews with top traders by Jack D. Schwager. So we have 4 books. There's going to be another one as well later on. So we'll be asking 4 questions throughout the night. And the first person to email us with the correct answer will win a copy of one of the books. So get your pen ready, or your tablet, your phone, whatever it is, and take down this email address so that you can be the first to submit your answer and win one of our fabulous prizes. So in order to win, you send an email to wealthinfo, that's wealth, I-N-F-O, info, at myvmgroup.com. Wealthinfo at myvmgroup.com. So send an email to that email address with the answer and the question number in the subject line, and the winner will be notified directly via email within the hour, and I'll also announce it towards the end of our program. So here's the first question. You ready? Dun-dun-dun-dun. Give me a drum roll. Dun-dun-dun-dun. Dun-dun-dun-dun. All right, the first question is, name 2 ways that investors make a return from investing in stocks. Got it? Name 2 ways that investors make a return from investing in stocks. Email your answer to wealthinfo at myvmgroup.com and you can win one of our prizes. And you also have to put in the subject line that it's question number 1 that you are answering. Yeah? So looking forward to that. That said, let's move into our program. We have 3 exciting speakers this evening, and the first one is Resworth Burchinson. He's the CEO of VN Wealth Management. Now, Resworth's foray into the financial services sector began at Sigma Investments Limited in 1995, where he was employed in the role of investment analyst. His drive for success saw him being promoted to equity research manager and later vice president and general manager at the merged Pan-Caribbean Asset Management Limited, with an overarching responsibility for managing Jamaica's largest unit trust. That's the Sigma Unit Trust. You guys heard about the Sigma run, right? So in early 2006, Mr. Burchinson, we call him Rez for short, joined Prime Asset Management Limited, which was later became Victoria Mutual Pensions Management, and he went on to excel as the Chief Executive Officer. So he's somebody who has a lot of experience, a lot of background. Well, on September 1, 2016, following a restructuring exercise within the organization, Rez took on the additional role of Deputy CEO for Victoria Mutual Wealth Management, which is the investment arm of the Victoria Mutual family. He was promoted to CEO of Victoria Mutual Wealth Management in January 2019. And throughout his career, he's been consistently involved with various corporate bodies, including as a director of the Pension Funds Association of Jamaica, also as a member of the Jamaica Stock Exchange Best Practice Committee. He's also a former director of the National Road Operating and Construction Company, NROC, the Education Trust, the Human Resource Management of Association of Jamaica, and a former member of the PSOJ's Economic Policy Committee. So his resume, long. Yeah. In 2012, Rez was named to the PSOJ's 50 under 50 in the field of investments and finance. I have some confidence that this is somebody coming to you as an expert. He's a Barclays Bank scholar, while at University of the West Indies, he received a bachelor's degree in economics with honors and an MBA in banking and finance. So here's our first speaker, Resworth Burchinson.
Okay, good evening or good afternoon, Kalira. Thank you for that introduction. It's way too long. Didn't know that you would say that I left school in 1995 because I thought I was the representative of the Millennials, not Mark, but I will hold it against you. So thanks to Chad and Mark for joining us this afternoon. I'm looking forward to those presentations. And also to the, I think by now we should have over 1,000 participants. Thanks for the participants for logging on to another, what should be an exciting afternoon of information sharing. So let me start my presentation. It's a bit long, so I've been told it's long, so let me kind of get the ball rolling. So I'd love to start my presentation with a quote. So I have two quotes here, and it's important because of the time in which we're investing. People succeed in the market except periodic setbacks. It's important because, you know, there are a lot of Jamaican investors would have had success in 2017, 2018, 2019, and then whoops, we have 2020. And they're saying, well, the world is falling apart. It may be, but the world isn't coming to an end, that's for sure. And then this other quote from Jesse to say, whatever happened in the stock market today has happened before. So we've been through many such challenges over the past 40 years, and I'm quite sure we'll get over this one. The duration we don't know, the extent of the damage we don't know yet. But one thing I'm confident of is that we will get over it. And then my second favorite slide is showing why it is that stock is the best performing asset class. So the amazing team that work in research at VM Wealth actually did some digging to say, well, we talk about stocks all the while, but really how is stocks compared to money market, compared to US dollars, compared to inflation? What we found going back 45 years, actually we have 48 years of data, is that without a doubt, over the long term, equities is the best performing asset class. And I want to put some context behind it, right? And again, something I read, I didn't experience it, but the Jamaican stock market went through the oil crisis 1973, democratic socialism, structural adjustment, Hurricane Gilbert, liberalization, the stock market crash of 1991, FinSac, went to a number of debt exchanges. And I can tell you, if you speak to seasoned investors who have been investing for 10, 15, 20, 30 years, they will repeatedly tell you that you have to buy equities. So I want to start off with that. And then, why also do we like stocks? It's a perfect inflation hedge. Actually, it's more than an inflation hedge. Two reasons. First of all, as a business owner, you get to, if you're in an efficient business, to pass on price increases to your customers. That's one. But secondly, as your business is growing, your market cap and the value of that business is also growing. So for example, if you have a company earning $1 million, trading at a P of 8, so the market cap is 8 million. But over time, if you can get your business to move to generate net income of 10 million, trading at a P of 8, the market cap is now $40 million. Secondly, dividend provide a steady flow of income. And then thirdly, in as much as persons sometimes recoil from equities, it's the most liquid asset class there is. More liquid than real estate, more liquid than private equity. So we say, you really have to consider equity investments. Secondly, before I continue, you have to consider risk management. Persons always say, equities will involve some level of risk. Every single asset class, every single investment under the sun will entail some level of risk. What I say to persons is that, what is your risk appetite? Can you financially absorb that risk? So for example, if your portfolio falls by 20%, how will you feel? And also, do you have the capacity to absorb that shock? Your portfolio falling by 20% doesn't mean that your standard of living will change. And then the best thing to do is to have time on the side. So we say to persons, when you invest in equities, you have to invest for 5, 10, 15, 20 years down the road. How do you manage risk? We'll get into this a bit later. Diversification across a number of assets of stocks across different sectors. You want to invest over time so that periodic setbacks, you will bounce from those periodic setbacks. You want to rebalance your portfolio from time to time. So you may have an asset in a portfolio that gets a particular value, which is what you determine to be intrinsic value. You rotate to another stock, and also limiting your exposure to a particular company within your portfolio. So at VM Wealth, the team, in as much as we do trade around the portfolio, we are long-term investors, and we do what I call fundamental analysis. So we're not actually traders, because we believe that some of the stocks that we own will deliver value and deliver value over the long term. There may be blips along the way, but the long-term approach is the best approach. Some considerations. What's the business fundamentals? How is the business doing? The P&L, is it growing? The balance sheet, is it strong? Is it generating cash? How is the environment in which the business is operating? Is it gaining market share or is it losing market share? And then also fundamental is the valuation of that business, because oftentimes you have a great business gaining market share, great fundamentals, but the valuation isn't just right. Maybe it has gone up in price. I want to say, as much as this business is a great business, considering the future prospects in the valuation, you want to move on to something else. So you have to look at all three components to determine how you move forward. Before you buy, you have to determine, what is it about the stock that I like? Do I have an exit strategy? So do you have an exit price in mind? And continue to assess the environment to say, I changed the environment, changing my outlook for this particular company. So I spoke about it before. Things to consider: management, leadership is very important. And again, we're seeing a number of Jamaican companies on the junior market, on the main market, who continue over various market cycles to deliver value to the investors. So management is important. We spoke about it before. Look at the capital structure. One note on the capital structure, because oftentimes I get the feedback from investors to say, I got burnt in stocks, in the 1990s. The capital structure of listed companies is fundamentally different now than it was in 1991. In 1991, what the companies were debt-ridden. Actually, no, the case could be made that many companies have too much cash in their balance sheet. So in other developed markets, you'd have shareholder activism about returning some of that excess capital to shareholders in terms of dividends. We spoke about cash flow. Cash flow is important. We spoke about industry. How is that company positioned in industry? Is the industry growing? But also, is the industry likely to be disrupted? Or is that company the disruptor in the industry? And certainly, we have seen a number of cases in the past 3 months based on COVID, where the companies leaving capabilities to gain market share in a particular industry. Especially in a core environment, digital capability is fundamental. We speak about remote work, persons buying online. So again, as we move forward and you assess your companies for 2020, for investment for 2021, 2022, you have to look at digital capabilities and then look at the customer experience that a company is giving as a guide to satisfying customers. In your portfolio, you must have a mix between fast growers, companies with low multiples, strong dividend flows, a dark horse, a positive earnings surprise based on some restructuring, and companies that trade at some discount to value. So in your portfolio construction, you really want to have these 5 themes, obviously weighted based on where you believe a particular sector is going to go over time. So this chart, which shows investor sentiment on the stock market, is a chart that I do believe that whether you be a novice to the market, experienced, we ought to look at, because it tells the emotional state that we go through based on the various market cycles. So when the market is bottoming, persons ignore. As the bull market steps in, move from ignoring to get excited. And then at the height of the bull market, that's when euphoria and greed steps in. So it's important that you understand the market sentiment. So a question could be asked is, where is Jamaica? Where is the US stock market in this cycle? Because it will tell you how you ought to position your investments, especially equities, based on the various market cycles. So I found this cartoon many years ago, and it's instructive that it was one about the time of the bird flu. Now we're dealing with the COVID pandemic. Why is it here? To reiterate the point, we'll always have challenges. We will always have challenges, and the narrative will always be, the world is falling apart, sell all the stocks, let's move to the hills. That may be the case. I don't believe that's the case now. I believe that we're going through painful market correction locally and internationally. The duration we don't know, but I do know that we'll get out of it. So it can't be that we recoil from our core as it relates to our investment principles. If you're still saving for your vacation, your retirement, your children's education, continue to save. Actually, there is a quote that says the best time to buy stocks is during these challenges. So if you look back to when Jamaica was going through its IMF program, the best time to have bought Jamaican stocks was when we were at the bottom of the barrel, when the IMF was ignoring us, when we're going through our debt exchanges. So I kind of put that there to say that there will be fear, but as long as you remain true to your investment principles, I believe that over the long run, your investment portfolio will be duly rewarded. So we spoke about the fintech recession. 2 points here: the capital structure of companies fundamentally different. That's one. The regulated environment is fundamentally different. Actually, in this pandemic, we have seen the authorities on the monetary side and the fiscal side really step up. The Ministry of Finance, the Bank of Jamaica, and the FSC. So for those of us who are regulated by the BOJ and FSC, there is an additional level of diligence, because obviously the authorities want to ensure that the players in the market are adequately capitalized to absorb these shocks. And the various reports from the authorities will indicate, actually, just today in the paper, the BOJ would have shown the asset and liability and capital structure of some of our companies in the regulated space, and you can see that they're adequately capitalized. The Great Recession, obviously very painful for US investors, very painful for US investors and Jamaican investors, but bargains will always materialize during these cycles. One example that I'll give, as I remember during the Great Recession, I was watching Bloomberg one night, and a particular hedge fund manager came in and said, I recommend General Growth Dynamics, GGD, which is trading at 50 cents. That company now no longer exists, but when it came off the market after being restructured and bought out, the trading at $30. So it tells you, so that's the overseas example. And again, if you look at what happened in the Jamaican context 5 years ago, you will realize that these opportunities, a market downturn is a great opportunity. And it doesn't mean that investors are supposed to run out and buy equities. It means that you need to ensure that you understand the companies in which you're investing, understanding the drivers of growth, understanding the variables and the metrics that can destroy value, and continue to evaluate those metrics from time to time. So as we go through this period, persons are going to say, well, how do I know when the economy is starting to change? There's a word that was being used after the Great Recession called green shoots. So green shoots simply mean that there's a decline in the unemployment rate, increasing business confidence. In the Jamaican context, obviously you want to see an increase in our key sectors, whether it be tourism, remittances, or bauxite and aluminum. And then you want to see an increase in private sector credit. So for those local investors who are saying, well, how do I know when the situation is changing? You really want to pay attention to these variables. Well, additionally, is that Jamaica is in a much better state from an economic standpoint than it was 5, 10, 15 years ago. We've made a lot of sacrifice. We've gone through a number of IMF programs, successfully coming out of this program, and our economic numbers are stellar. When we speak about inflation, when you think about the reduction in debt to GDP, when you speak about even though there's going to be an impact to the primary surplus in this fiscal year, but a material improvement in some of these things, which allowed the monetary, the fiscal authorities to provide the stimulus package that was discussed some weeks ago. So in closing, something I want to reiterate, we look at a stock price. So a number of persons will say, well, a stock is trading at the price of 1, vis-a-vis a stock is trading at the price of 200. And invariably, investors say, well, I want to buy the company, which is trading at a stock price of 1. So I said price and absolute, you have to look at the relative value. My go-to for value for relative value is a PE ratio. So as explained to me some years ago by the master John Jackson, is that the P is simply the payback period. And obviously, the lower the payback period, ceteris paribus, is the better investment. So if I buy a stock with a P of 8 vis-a-vis a P of 15, the stock with a P of 8 will give me a shorter payback period, and the shorter payback period is also a driver of growth. You don't want to fall in love with a stock. You really have to constantly evaluate your position. So I know a number of investors will watch these talks, will get some stock picks. So I would say buy company A, and tomorrow morning they're buying company A, and they haven't read the annual report. They haven't read any analysis of the company from the other players. And that's foolhardy. You really want to understand what's driving value in the company, understanding the strategy of the company, understanding how the company have done over the period, so that once you understand the drivers of value, you can continue to evaluate a company from time to time. You have to know when to sell. So what is undervalued vis-a-vis fully valued? Fundamentally, you have to learn to be patient. You have to learn to be patient. Too many investors invest seeking a return in 2 months, 3 months. The investment greats of this world and also Jamaica are patient investors who invested 5 years ago, 10 years ago, 15 years ago, and continue to invest, and they're seeing their return, their portfolio appreciate. You have to really understand the stock in which you're invested and stand up to your position. And it's here because a number of persons of managed portfolios, they go to investment committees, or they even talk to their friends or their spouse about investments. And you say, well, there are 10 reasons to invest in a stock. There's always going to be a reason not to invest in a stock. But as long as that reason, the negative reason, doesn't impact value, you have to move forward. And then, it's kind of funny, but you'll graduate after you experience a market shock. So a number of new investors to the market would have made money in 2017, 2018, 2019. And believe that there are no pros. 2019 is a real, 2020 is a real test. What I'll say to investors though is that don't be disheartened. It's gonna be a glitch. It's gonna be painful. It's gonna be protracted. But once you remain true to your core, your investment portfolio will pay off. So I know persons always ask for stock picks, a few stock picks. These stock picks are actually on our website at VM Wealth. The stock picks, they're generated by the amazing research team at VM Wealth. The research team at VM Wealth is the best research team in Kingston, bar none, right guys? Yes. So it's here, Carreras, Victor, GK, Jamaica Producers, Genac, and Mailpack. A mix of dividend and a mix of growth. But having said that though, we have to really watch earnings. We have to watch drivers of growth. So tomorrow morning, don't give me an order for Carreras. Ensure that you read the Carreras annual report. Ensure that you read the VM Wealth analysis before you go to buy Carreras. Just some food for thought. And to connect to what the drivers of value for these companies as you move forward. So for example, if you're investing in the banking sector, you have to really watch non-performing loans. Very, very important. You really have to watch the growth in the balance sheet. So just some tips as you go throughout making your investments in the weeks ahead. So how can we help? We stand ready and waiting. Actually, this seminar is one way of educating our clients. So speak to any one of our wealth advisors. Actually, everybody on this call will call by a wealth advisor next week. And Kalila did point out the email address if you want to get information on our daily investor update, or money moves, or company analysis, or stock picks, or newsletter, and also we've started our COVID investor update. We are in our pilot for our international trading platform, because investors are saying, whereas I've a fair bit of my portfolio in the Jamaican market, I've done fairly well. I want to be exposed to more developed markets. I want to buy the Googles and the Amazons, or if you want to buy the airline companies or the cruise line, which you believe, or the biotechs that you believe will deliver value in the medium term. Again, let us know, and we'll include you on the pilot. Before I close, though, there are some investors who will say, whereas what you're saying is there's too much work. Well, guess what? We have a product for you. We have our award-winning equity portfolio, which has generated return between 25 and 30% for 2017, 18, and 19. So if you want to take the passive approach and give the hard work to us, which we love to do, invest in the VM Wealth equity portfolio. And again, in closing, I want to leave with a quote from Colin Powell. It says, "There are no secrets to success. It is also preparation, hard work, and learning from failure." And then one last thing, with some book recommendations. I know Khalila spoke about it before. The two books I really love is Rich Dad Poor Dad by Robert Kiyosaki, and the Jack Schwager series. For those of us who love stocks, it's the Bible. Once you start reading that book, you won't put it down. It's a Bible for especially Mark and his millennials. So that concludes my presentation, Khalila. I'll hand back to you, and on the Q&A, I'll take some questions. Thank you.
All right. Thank you so much, Rez. Lots of gems dropped in that presentation. And of course, you guys will have the opportunity to ask questions. I was jotting down some notes, like frantically making my own notes so that when the question time comes, I can ask on your behalf. I know that a lot of you have been sending in your questions as well. So we'll get an opportunity to ask that, and you can go more slowly, Rez, because I know you're dropping those stock picks quick, fast, and hurry, and people are trying to take notes and they might have missed it, but we'll have an opportunity to go back over those. So we have a winner for our first question. Congratulations to Davian Sterling. Davian Sterling, congratulations to you. You are the winner of question number 1. And to remind you, over 50 people, by the way, submitted answers to that question. So you guys are on the ball, man. The question was, name 2 ways investors make a return from investing in stocks. And so for the others who are curious about the answer, you can make a return from investing in stocks by dividends. Some stocks generate dividends and they pay you every quarter, every half year, every year when the company makes a profit. It varies from company to company. And then the other way would be by capital appreciation. So when the cost of the stock, or when the price of the stock goes up, let's say you bought it for $1 and within a year, the stock price is now at $2. If you sell that stock for $2, you've just made $1 profit. So that's another way that you make money by investing in stocks. And I have another giveaway now. It's time for giveaway number 2. Let me bring up the question right here. You can win yourself one of the wonderful books that I described earlier. By the way, Rez, Rich Dad, Poor Dad, listen, it's key, changed my life many years ago. It's the first book I really read about finance and investment and that type of thing, life-changing. So our second giveaway of the evening is, here's the question. What sector did the BOJ declare no dividend payments for this year? What sector did the BOJ declare no dividend payments for this year? I did a whole program on this on YouTube, so you guys should know the answer. Remember to submit your answer to wealthinfo@myvmgroup.com. That's wealthinfo@myvmgroup.com. And put question number 2 in the subject line. The winner will be notified directly via email. Easy question, easy peasy, right? All right, so let's move along with the program. So next we have Chad Morganlander. He is the Senior Portfolio Manager and founder of Washington Crossing Advisors. So he's our foreign expert this evening. So Chad serves as a Senior Portfolio Manager and co-founder of Washington Crossing Advisors. He shares responsibility as co-portfolio manager across each of the group's investments advisory programs. He's held several investment advisory and analyst positions for Stifel and predecessor firms, including Ryan Beck and Company and Gruntel and Company. He began his career in 1992 at the famed Lehman Brothers. Chad brings nearly 25 years of financial market experience. Wow, more than I've been alive. Investment advisory and portfolio management experience to the WCA platform. The WCA multidisciplinary investment platform has assets of over 5 billion with a B, US dollars under advisement. Chad regularly comments on the global economy and financial markets on various media outlets, including CNBC, Dow Jones, BNN, Bloomberg, CBS Radio, Fox News, the Wall Street Journal, and Reuters. So if you're in tune to any of these channels, you may have seen him, may have heard him. Chad graduated from Ramapo College, where he received his Bachelor of Arts in International Business. Let's welcome Chad Morganlander.
Well, thank you for having me. I appreciate it. Today, what I wanted to do was review what's happening in the United States, also the economic implications in 2020 and going into 2021. Also, want to talk to you a little bit about the stock market in the United States as well as the bond market. So let's get started with what we're seeing for the first half of 2020. Unfortunately, as we all know, the coronavirus, the pandemic that is now global, has completely shut down the global economy. And in fact, starting in March to April to May, and now slowly in June, the US economy was drifting from a growth rate at the start of the year of roughly 2 to 3% GDP growth to a deceleration where in Q2, economic activity plunged close to 40%. In fact, it's been remarkable. You have seen an unemployment rate where there are over 20 million US citizens today that are collecting unemployment. Now, with that said, of that 20 million, many of them are looked upon by the financial markets as being temporarily unemployed, or better known as furloughed. So that in itself will be one of the critical things to watch going into the months of July and August. Now, when we take a gigantic step back, one thing that I wanted to point out is that the United States is roughly about 25% to 26% of global GDP. The other 25 to 26% is the European as well as the Japanese economy. And then the remainder is what they call the emerging markets and whatnot, which accounts for also China. So one of the critical things to note about where we are today is that in the United States, this massive drawdown of consumption, due in part because of coronavirus, is going to be one of these issues that will be transitory. Now, what I mean by that, transitory, is that it's going to take time to work out of the global economy. And that is going to occur based off of water markers. And it's not going to be economic water markers, but rather healthcare water markers. So when look at going forward over the next 3 to 6 months, the focus should critically be on a vaccine, also various therapeutics, so that if one does get ill, they could go to the hospital or take treatment at home. These two things could be a substantial game changer and allow tourism to start to come back into the overall economy to come back, and for people to start traveling, not only in the cruise industry, but also to get on planes. Here in the United States, where I live in New York area, we've had a great deal of slowdown, due in part because we've had to shut down our economy by a tremendous amount. over in New York area and surrounding New Jersey metropolitan area, there's been over 35,000 people that have passed away from this disease. So it is a dreaded, serious disease. Healthcare watermarks and developments on that side will take us out of this. Our anticipation is that we're going to see an improvement of economic activity over the course of the next 6 months. You're starting to see an increase of mobility here in the United States. There will be starts and stops in different regions based off of how developed the virus is to the US citizens here. But we believe that overall, that by the second half of 2021, going into 2022, US economic activity will be back well above where it was in 2019. So what does that mean to you as an investor? One of the things that is critical in that was spoken about from your previous speaker is patience. Patience is the most important aspect of this. If one is patient, then we can be able to ride through the investment cycle, the bad times as well as the good times. A couple of other things to note. We believe that investors should not be overly pessimistic at this juncture, because these healthcare watermarks, even though economic activity may not kick higher to levels that are exciting, any type of development from a healthcare side will actually accelerate optimism for investors, US-based investors, as well as global investors across the globe. So a couple of other things that I would like to talk about, and that is fiscal stimulus in the United States and monetary stimulus. Fiscal stimulus has been one of the key saviors of this issue, and that is that the U.S. government has greatly enhanced various programs to keep not only U.S. citizens working, but also the unemployed to get actual money that is more enhanced to get them over this issue and this terrible time. Also, we're anticipating that in the second half of 2020, there'll be an improvement of more fiscal stimulus, regardless of any of the healthcare measures. Being because there is going to be an election, we believe that politicians here are more likely to increase their pocketbooks to give more to the citizens from that side. Now, monetary stimulus, the Federal Reserve. The Federal Reserve here in the United States, during this massive credit dislocation in March and April, came to the rescue. They actually borrowed a tremendous amount, bought back securities to increase quantitative easing. We believe that calmed down the overall credit system within the United States, so that companies like McDonald's and Starbucks were able to get smooth lending for their overnight debt, their overnight obligations. That was one of the major stresses. There was a lot of financial stress that started coming into the financial system back in March and April. That is no more. So the Federal Reserve will continue to be very accommodative and help the financial system here in the United States. That's why we're more optimistic over the course of 2 to 3 years. I think investors should look out 2 to 3 years. If you're looking out 2 to 3 months or 6 months or 9 months, I think that's a foolhardy way to look at this. Broader diversification and higher quality companies, I believe, is the more important thing that one should look at right now. So as an example, Washington Crossing Advisors, I founded the Washington Crossing Advisors with my partner, Kevin Karan and Joseph Battipaglia 15 years ago. And we look for companies that are very clean. And what I mean by that, they have to have 3 watermarks. They have to be consistently growing, consistently profitable, and they cannot have a lot of debt on their balance sheet. They have to have a boring, steady Eddie type of business to them. Predictable is very important. Predictability is very important. And lastly, being that we run a rising dividend portfolio, like your previous guest has said, dividends do matter. We like companies that are increasing their dividend each and every year. This strategy has been very consistent with a dividend growth rate of over 10% and a yield of roughly 2.2% in US dollar denominated assets. With that said, we believe that US dollar denominated assets at this point in time, one should have that in their portfolio. It does not have to be a majority of one's portfolio, especially if you live in Jamaica. But we believe, though, that you should have a well-diversified rising dividend strategy in one's portfolio over the course, and this is the critical thing, patience over the course of an investment cycle of 3, 5, and 7 years to allow these companies to grow, reinvest back into their business, and grow their cash flow. The critical aspect of that capital appreciation that we're talking about and is that you need these companies to reinvest back into their business, and these companies should not have a lot of debt. So with that said, the last thing I want to talk about is the US bond market. The US bond market is at historically low interest rates at this point. In fact, we did a study, and never since the time of history, since going back to Babylon, have interest rates been this low across the globe. We do believe, though, fixed income should be in one's portfolio, but one should ladder the portfolio where bonds are expiring every year. 10% of the portfolio expires every year in the highest quality fixed income instruments. That would be our advice to individual investors as well as pension funds. One of the things about why interest rates are so low is because monetary policy has been incredibly accommodative, not only here in the United States, but also within the European countries like the ECB, European Central Bank, the BOJ, the Bank of Japan, and the Bank of England. So we expect interest rates for the next several years to continue to be low. So that's what we would do on the fixed income side, be in the highest quality bonds, expect the Federal Reserve to keep rates very low, to be quite accommodative, keep a careful eye on the healthcare side of this over the course of the next 12 months. That will actually move the market, and watch the gradual improvement within the US economy and as well as the European and Chinese economy for additional drivers to increase the overall amount of global growth. So that's where we are today. I'm open for questions at the end of this, but I also want to thank everyone on the call for allowing me to participate.
Thank you very much, Chad. So a lot that we can learn there from Chad. So one of the things that he said is that you should be diversifying at this time. Make sure that you invest not only in Jamaican dollar stocks, but US dollar stocks. And of course, Victoria Mutual Wealth Management can help you do that. Looking at the US bond market, and one of the key takeaways that I took from Chad, he said, look for companies that are consistently growing, consistently profitable, and don't have a lot of debt. I think that's a major key, and we can come back to that. Now, before we move on to our next speaker, let me announce the winner of our last question. The winner for question 2 is, are you ready? Dun, 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 dun. Drum roll, please. Congratulations to Jason Edwards. Jason Edwards, you are the winner of one of the books that we had mentioned. And let me just remind you what the question was. So we had asked, what sector did the BOJ declare no dividend payments for this year? And the answer was the financial sector. And the reason I say was is that they later walked that back for small investors. So for investors who have less than 1% of a company's shareholding, which is the vast majority, you are still allowed to collect your dividends this year. So let me go into question number 3 before we introduce our next speaker. So the third question is, what are 3 statements that most people analyze when looking at the financial position of a company? 3 statements that most people analyze when looking at the financial position of a company. So submit your answer to wealthinfo@myvmgroup.com and put question number 3 in the subject line. We'll notify you directly via email as to how to collect your prize, and I'll also mention it here. So let's move on into our third speaker. Mark Gale is a friend of mine. He stood in for me on my own program, Taking Stock. So he took over the reins. He's a regular guest on that show as well. And he, in his regular life, not TV life, or I should say YouTube life, because my show is on YouTube, he actually is the CEO of a company called TCP Things. You know those handbags that you see that have one bag of things on it, one bag of picnic things, one bag of whatever things. TCP Things, TCP stands for those creative people. They're the ones who invented those, who designed those bags. He's also a financial analyst, very prominent on Finance Twitter, JA. Mark has had a love of complex systems for decades. This love led him actually to software development, finance, and economics. He has an MBA with a concentration in finance at the University of Tampa and a BA in computer science at Eckerd College a few years prior. And then he decided to move back to Jamaica with his wife and to raise his expanding family. There's a lot more stuff here about Mark, but we're running a bit behind time. So let me just let him get right into it and tell you all about the millennial stuff. Hi, Mark.
Hi, Kalila. Thank you for that very wonderful introduction. I feel a little overwhelmed, but thank you. All right, so my presentation today, I'm going to just do a share screen real quick. So I'm talking about millennials, all right? The title of my talk is Investing for Millennials, How Jamaica's Golden Window Can Help You Build Wealth. And so I have this hypothesis about the golden window that I'm going to explain and how it, can affect you. So, as Kalila said, I'm Mark Gale. You can find me on Twitter at Mark Gale, and big up hashtag Finance Twitter JA. It's a great resource to learn about everything to do with finance, specifically about Jamaica. All right, so there are 3 reasons, in my view, why it's a great time to be a millennial in Jamaica right now, right? The first one is the power of compounding. Number 2 is that equity investing creates significant amount of wealth. And then 3 is that Jamaica's golden window will likely continue to produce above average returns. And, all of these three things are very important, and we're going to kind of like dive into, all of them. So the first thing is that whenever, we talk about finance or investing, one of the most popular questions that I get, on Finance Twitter is, do I have to have a lot of money, or invest in the stock market is just for rich people? And it's actually absolutely not. I believe that investing is the great equalizer. It's not just for rich people. And the reason is because of compounding. Compounding is a very, very powerful principle. It's a very, very powerful force. And just for those that are not aware of what compounding is, essentially what it is that when you invest your money in year one, so let's say for example, you invest $100, right? So that's your principal. You start with $100. At the end of year one, you have 50%. You make 50% returns. Well, at the beginning of year 2, what you'd be starting off with is $150 because you've made $50 on year one's principal, right? So in year 2, even if you make 50% again, in year 2, you make $75. So you don't make $50, even though you've still only made, the 50%. So you make the same return as in 50%, but you make more money. And that is because you start off with more money. So your principal is higher, right? And so essentially, if you keep doing that and you keep, making money with more money, then you make more money with more money. And the more time that you have is the more that grows and so on, right? So the 3 key elements of compounding are time, the starting principal, and the average annual returns. And if you have issues with one, then you can make adjustments to another, right? So that's kind of those are the three things that we're going to dive into, and you're going to see why I say it's great to be a millennial. Now, what I want to kind of drive home here is to kind of articulate the true power of compounding, right? And to drive this point home. So if you start off with just 5,000 Jamaican dollars and you add $500 a month, right? And you do this consistently, and on average, you make about 12% per year for 50 years. So let's say you start when you're 18, for example. By the time you're 68, if you start with those figures, you'll have $17.6 million Jamaica, right? Now, if you change any of those variables, so let's say you change the amount of money you start off with, and you have $500,000, and you add $50,000 a month. But instead of, let's say you start later. So instead of, starting at, 18, maybe you start at 38. So you have less time, right? So you have, 25 years instead of 50 years, and you still make the same amount of returns, 12% per year for 25 years. Then you end up with $98 million, right? So here we saw the time got cut in half, but the principal started, the principal increased significantly, and then so did the monthly contributions, right? So that's scenario two. So the third scenario is that if you start off with the same $500,000, you add $50,000 a month, but the difference is your total time is 25 years, so you still start when you're 38. But the average returns that you get are 20%. So instead of getting 12%, you get 20%. Then rather than ending up with $98.1 million Jamaican, you end up with $387.5 million Jamaica, right? And again, this is an average 20%. So some years you may make less, and some years you make more, but that's just the average, right? So you can get an idea of how the different variables kind of impact your overall returns. Now, and then also, if you take this, let's say you start off with $5,000 again, you add $500 a month. That's $6,000 a year. But then instead of earning 12% a year for 50 years, now you earn 25%. So you earn essentially double the returns. Your total amount that you end up with in 50 years is $2.45 billion. So it's not 17.6 million. So so it has increased from 17.6 to 2.45. So it's an exponential increase. And so by simply just doubling the amount of returns that you get every single year. So when you kind of like look at the numbers, it really drives home the power of compounding, which is why I say that it is very, very beneficial to be a millennial, because you're younger, you have more time, and so on, right? Okay, so here we have a picture of the Forbes, according to Forbes, the richest people in the world, right? And the most common, or the common denominator with all of these guys is one thing. It is equity. All of them own a significant amount of equity. Or said another way, the bulk of their wealth is generated from owning equity in companies, right? Now, some of them have started the companies themselves, but then some of them are investors, right? And number 3 here is Warren Buffett. He's the best investor in the world, the longest track record, 50 odd years. And so here we're seeing, he's the third richest man in the world, right? So the principle of owning equities, I'm just using this as an example just so that you can understand the power of equity generally, right? And then this is another interesting headline that kind of grabbed me when I was doing some research about this. Is in 2019, this is as at September 17th, 2019, Bill Gates gave away $35 billion. This is US terms, right? $35 billion in that year. So in 2019, in the first 9 months of 2019, he gave away $35 billion. But even though he gave away $35 billion, his net worth still increased by $16 billion, right, in 2019. So that also, and the reason is because a big chunk of his net worth is invested in equities generally, right? So what that means is that his overall net worth increased by $16 billion more than the $35 billion that he gave away. So just food for thought. So we've heard great things about equity investing and stocks. What are the risks, right? So obviously the biggest risk is that the price can go to zero, and typically this only happens if the company files for bankruptcy, right? Or is like extremely troubled. But if the price goes to zero, then you do lose everything. So this is why you need to make sure that you do your homework, and you know that you are you understand the companies that you're investing in. So like both Rez and Chad, just spoke about, understanding what you're investing in, focusing on the fundamentals, looking for, consistently profitable and consistently growing companies. Those things are very, very important. I actually teach classes that teach you how to analyze companies on a fundamental basis. So if you have any interest in learning about this stuff, you can DM me on Twitter and we can discuss it. But yeah, so basically what you want to do is arm yourself with knowledge so you can understand how to identify the risks of you losing everything, and then you figure out ways about how you can minimize it. So that's the first risk. And then the second risk is really and truly that you're more likely to just lose a portion of your investment. So you're not likely to lose the entire thing. In most cases, you're more likely to just lose a portion. And then also another risk is that in the event of bankruptcy, you can end up getting zero because creditors get paid before equity holders. No, so that's the risk to owning stocks. Now, what are the risks to not owning stocks, right? So let's say you say, okay, I'm just going to take all of my cash and put it in my, bank account, in my savings account. Well, in Jamaica, unfortunately, the savings rates are, they're not that great, to put it mildly. According to BOJ, these are the weighted average interest rates on savings accounts across all commercial banks in Jamaica in 2017 and 2018. And I mean, these are, I believe, these are annualized rates. And so, here you're seeing some, really nosebleed, 0.69% on your money every single year. So it's this is your alternative, essentially, aside from, investing in other asset classes. So what is the golden window and why does it matter to you? So in my view, the golden window is a period of time during which a country is developing, typically in decades, when the country develops fast enough to create significant wealth for many of its citizens, right? So that's a general way to think about it. And where have we seen this before? Here are some examples. After World War II, in the US, we have the baby boomers generation, where a significant amount of wealth was created for that generation. And then also after World War II, you have in Germany, you have what's called the Mittelstand, which is the kind of the middle class. They make a lot of industrial equipment, a lot of like engines and, plane parts and, car parts and, the phrase from, BMW, German engineering, that comes from the expertise that the German middle class has developed, from this whole Mittelstand kind of industry, right? And you also have Asian tigers, Singapore, Hong Kong, Taiwan, South Korea, from the 1960s through now. You have China after Mao, from 1980s, through recently, where their growth rate has been phenomenal and tremendous wealth has been created. And so I believe that Jamaica, has entered our golden window, even though it's kind of temporarily disrupted by COVID. But I genuinely believe that we are entering this, new window of significant growth over the next few years. So how do we know Jamaica is entering this golden window? Well, our economic fundamentals have improved significantly, right? So the years leading up to COVID, our GDP growth, even though it's lower than we would want, it has improved significantly. Unemployment it came down significantly it was constantly hitting all-time lows, meaning more people were getting jobs and finding jobs than have ever before in the history of the country. And more importantly, government debt relative to GDP, so the amount of debt that the country owes relative to the amount of income the country earns, is also at a significant low. It's down from 150% 10 years ago to roughly about 90-something% as of last fiscal year, right? And again, that will be kind of disrupted because of Corona, but generally speaking, we expect this to continue. And so, as because debt has come down, that has led us to these type of things. Where Bloomberg headline about the best performing stock market in the world. This was in 2018. So that was Jamaica made headlines where the stock market is just performing crazy good. And then this is also a nice graph comparing the JSE relative to the S&P 500, which is in the US, the FTSE 100 in London, Shanghai Composite, and the Nikkei in Japan. So you can clearly see that the Jamaica stock market over the last couple of years have been performing above average. No, so that was, prior to COVID. Well, how have things been in COVID? So, if you look at, some of the returns in May, at the end of May 2020, which is in the knee deep in the middle of COVID, here you are seeing, these are the top 10 winners and the top 10 losers, right? So we do have some companies that really took, a hit, but they're the kind of obvious ones, right? So Palace, nobody's going to the movies, so their stock price, in May, fell 59%. But then on the flip side, you have Wigton and Kingston Wharves and, Epley. All of these companies in May alone returned, 20%, 30% growth just in May alone, right? So the point I'm making is that even in the midst of crisis, you can find solid companies that are performing really, really well, right? And so that was for May. This is year to date, right? So you have companies like 130 Student Living and Pulse Investments, that have year to date have produced, 50%, 60%, 20%, in the midst of COVID, right? And then, for the last year, Pulse is up 248%. Victoria Mutual Investments Limited is up 78.93% year to date up to May 2020. SCI, Cygnus Credit Investments is up 31%. And then on the flip side, you have Supreme Ventures is down 50%. Mayberry Investments is down 34%, and that they have significant Supreme Ventures exposure, so that shouldn't be surprising if you kind of understand, the links and the dynamics between all of this. So again, the key lesson here is that even though people are hurting and some companies are hurting, and things are not so great for some companies, there are some companies that are the stock price has been performing well. And the key thing is that what you really want to do again is to understand and learn what the fundamentals are, just so that you can differentiate between what the environment is doing, so what the economy is doing or what the corona is doing relative to what the fundamentals of the business are doing, right? And then so in terms of the golden window, right? So remember, we're looking through the power of compounding and the returns, and we spoke about the three elements: time, starting principal, and average returns, right? And remember, the figures that I used are in a 12%, and the most aggressive figure I used was 25%, because we are talking about long periods of time. And generally in the US, for example, the S&P 500 will generally produce returns of 10% for a 40-year stretch, a 50-year stretch, right? 8%, between 8 and 12%. No, but the JSE, since I'm just giving you these returns, since in 2015, the JSE index, this is the entire market on average. This is not one individual company or whatever. This is the entire market on average. In 2015, returned 95. It rose 95.7%. In 2016, it rose 26.94%. 2017, it rose 48.55%. 2018 and 2019, 30-odd%. And year to date, the overall average, the market has been down, 26% year to date. But, again, that is according to Corona. And, we saw just through, my other examples about the top 10 markets, winners and losers, that even though the market is down 26%, there are some companies, up year to date, 40%, 50%, 60%, right? So, I just wanted to kind of drive home that this notion that, okay, the Jamaica's economic fundamentals are very, very strong, and we are well positioned to continue achieving significant returns on our portfolio, and companies to continue doing better, precisely because the economic fundamentals are very, very strong. So, in concluding, I'd just like to say that we saw time is a very powerful ally as a millennial, because the earlier you start, the younger you are. The earlier you start, regardless of how much money you have, once you start early, you counterbalance the effect of not, quote unquote, holy of money. I actually have a thread on Twitter that gives you tactical advice about how to start with even $50. So again, you can DM me and I can share that thread with you. So that's point one. Point two, Jamaica's golden window, as a result of our strong economic fundamentals, will likely continue to produce above average annual returns, which will produce significant amounts of wealth. Savings interest rates are very, very low. You can buy equity in publicly traded companies, and you can also earn equity in private companies. So thank you very much. That is my presentation. I look forward to any questions. And Kalila, I hand the floor back over to you.
Thank you very much, Mark. Great presentation. As always, you always have a wealth of knowledge, and I love that Mark is able to break things down so simply, so easily, so that we can just all understand, what he's saying. So before we continue, let me tell you who the winner of question number 3 was. Congratulations to Alonzo Johnson. Congratulations, Alonzo. You win yourself one of the books that we had mentioned. And for those of you wondering, what was the answer? So the question was, what are 3 statements that most people analyze when looking at the financial position of a company? And the answer is cash flow, profit and loss statement, and balance sheet. Now we have one last question, one last giveaway. Here it is. How can an investor reduce risk in their portfolio? How can an investor reduce risk in their portfolio? So if you were listening carefully, I know Rez touched on it. I think all 3 touched on it, but especially Rez, you should know the answer to this one. Email your answer to wealthinfo@myvmgroup.com. Remember to put question number 4 in the subject line. You'll get a response directly via email. So now it's time for your questions, and we have a lot of questions that I'm seeing in the chat. But before we go to the questions from the chat, so I wanted to start with Rez, actually. So Rez, you breezed through something in your presentation that I wanted those watching and listening to be able to jot down. You gave a list of 5 things that people should, let me see where my notes are, where I wrote it down. You gave a list of, where is it? I can't find it. But there was a list of 5 things, or 5 ways that people can diversify their portfolio, 5 different types of investments that you should have. I remember off the top of my head that one of them was the dark horse. So Rez, just give us those 5 again.
Sure. So I think it's on the slide. I spoke to fast-growing companies. So in your portfolio, you need to decide how you want to weight it. Do you have fast growers? Secondly, companies that trade at low multiples. Thirdly, companies that consistently pay strong dividends, and so therefore excellent dividend yield. The dark horse, so you'll have a company going through a restructuring, might have been underappreciated by the market. You want to have that in your portfolio also. And then companies that trade at a discount to value. So, and the thinking is, you have to ask yourself, well, what if they were to sell an undervalued asset? What could they do with the proceeds? So some considerations as we build our portfolio, because oftentimes you may invest in fast growers, and then you hear, out of the blue, there's an acquisition for a material percentage over market value. Like, well, how come I miss this? So one example for those of us who are not millennials would be Lascelles de Mercado. So for years and years, Lascelles de Mercado paid 1 cent dividend. Always underappreciated by the market. And I think Mr. Ashenheim and the CEO, Billy McConnell, kept on saying, guys, we're going to company. And then comes along Lawrence DeBay from Trinidad, paying materially more than the market was valuing the company at. So some things that we need to look at. So for example, when you look at a balance sheet, and we just spoke about it before, when are those companies last valued? What's the value of the brand? We had D&G trading at $9 a couple years ago, which was bought out for $30. So some considerations as we build our portfolio.
Okay, thank you very much for that, Rez. So once again, fast-growing companies that trade at low multiples, those that pay strong dividends, the dark horse, and companies that trade at discount to value. So because of time considerations, let's go straight into some of the questions that we have from our viewers. Christopher wanted to know, are the updates available to non-customers of VM Wealth? Those are the updates sent via email. I believe they are, but Rez, you can answer that.
As a customer, you can't get Christopher. I'm joking. Chris, just send your email address to wealthinfo@myvmgroup.com and we add it to the database. But obviously, Chris, getting good value from us, from our awesome research team, we're expecting some business return. That's reasonable, right? Thank you.
So that email address is the same email address I've been giving to you all evening. It's wealthinfo@myvmgroup.com. Wealthinfo@myvmgroup.com. You can send an email to that address, get added to their mailing list, and you get all this free information, free advice, free stock picks, and all these good things. Rez, you're a popular guy on our chat. Latoya Cameron has a question for you. She says she wants you to share the list of recommended books to read again.
Let's go. One Upon Wall Street, Peter Lynch. Random Morton on Wall Street, Burton McKeel. Jack Schwager has about a series of market wizards, and again, that's the Bible. Psychology of Trading, Rich Dad Poor Dad, and the Bible from Warren Buffett, Security Analysis, and there are many others. Richest Man in Babylon is another one.
I'm actually reading that one right now. I started reading that one this morning, and it's a pretty short read.
Pretty short.
You can read it in an afternoon. Really good read. Richest Man in Babylon. So Nicholas Dundas has a question for Chad. He says, do you think Caribbean Cruise Line fits your criteria for one of the companies to watch for the next 3 years? That's a very specific question. Chad, have you been watching Caribbean Cruise Line? You're on mute, Chad. Chad, you're on mute.
Okay, sorry about that. Carnival Cruise Line is opposite of a kind of company that we would be a buyer of. A couple of reasons why. The balance sheet of the company, they do have a lot of debt. Couple of reasons. When we look at companies, we want a very consistent business that's well diversified, and also a company that goes and invests back into their business. But one of the critical things is cash flow growth, and as well, again, liabilities on the balance sheet. So what happened with Carnival is that they had this unpredictable drop off of revenues and free cash flow. And that is one of the critical reasons why the debt, so much debt, has now stressed out the equity holders. So we would rather not go into a company like that. We would look at a US-based company. If you want to be in the aerospace industry, General Dynamics, for example, you can buy Walmart. A company like Google, for example, is a fine company. All three of those companies have very little debt, rising dividends, and will over the next 3 to 5 years do well and not have that risk. The critical thing is that bankruptcy risk or reorganization risk. You want to stay away from that.
Okay, and that was among the profile that you mentioned earlier, that you want to stay away from companies with high debt. You remember you told us about you want to watch those that have high growth, are consistently profitable, and have low debt. So the debt profile is the one that throws you off from Carnival Cruise Line. Question from Mark Gale. It says, when will we come with a truly diversified index? I don't know that Mark's the right person because Mark doesn't develop the indices, but you might have some insight there, Mark. That question comes from Malik.
Yeah, I mean, Malik, I don't work at a JC, you know, I can't speak to that authoritatively. What I can say, generally speaking, though, is that, you know, the Jamaican economy is evolving, and so, you know, a lot of the companies that are listed are simply just a reflection of the economy, right? So you have a lot of financials, because financials have done well over the years. You know, we're seeing more manufacturing firms and distribution firms, you know, a lot of larger firms, previously family-owned, you know, Fontanas of the world, Wysinkos of the world, they are listing, as well. And so as the economy improves, and this goes back to, my golden window hypothesis, is as the economy improves, more companies will list in more industries. That will kind of encourage JC, to create more indices in more industries. So over time, basically, but I can't give you a specific response.
Another question for you, Mark. This one comes from Mika. She says, I like the compounding concept Mark discussed, but what financial products would yield those results? Fixed income assets, index funds, or regular savings?
Okay, definitely not regular savings. Fixed income, it can yield it if you reinvest all of the income you generate from those fixed income products. But generally speaking, in my view, equity products generally, but individual companies, if you have the capacity or the willingness, which I think everybody has a capacity, you just have to learn the fundamentals to identify solid companies and just invest in individual solid companies over time, meaning you buy their stock. But then aside from that, Rez did bring up some of the VM equity products that they offer. Last year he said 2017, 2018 that did 24 to 30%, per year. Those are respectable returns. So I would say equity generally speaking, and then the more education you can develop for yourself, and the more tools you have, and the more gems you can find, more diamonds in the rough that you can find before everybody else finds them, and you can benefit from higher returns over time.
Okay, I saw this question popping up a couple of times in the chat, so let me direct this one to Rez. Somebody's asking, what's the difference between unit trust and mutual funds in Jamaica?
So the simple answer is that it's the same thing. That's a simple answer. It's the same concept. It's a collective investment product where investors, me, Kalila, Chad, my mother, my grandmother, pool together and invest in various asset classes, whether it be equities or real estate, etc. So and it's a similar concept for. So the unit trust is the word is coming from the UK model, and the word mutual fund is coming from the US. So, but it's the same thing. And of course, that there are a number of local players in the market. Actually, I did mention our Jamaican equity portfolio, but we also have a US equity portfolio, which is invested in US equities, primarily in the S&P, where it tracks the performance of the S&P. And how we create value is some sort of market timing to ensure that we outperform the S&P. So we offer both.
Awesome stuff. So Rez, stay with us. Shauna McKay wants to know, since you did mention Lascelles de Mercado earlier, Shauna wants to know, which company do you think is best positioned to be the next Lascelles de Mercado? You should have seen that coming.
Shauna, I really can't answer that, right? But what I would say is, so one of the things that we used to look at for Lascelles is the price to book. Which all investment houses do. Obviously, our research team does it better than anybody else. The price to book is one indicator of value. That's one. Secondly, you really want, as I said before, to look at the valuation of the real estate or the assets that we have on the portfolio. So, for example, you'll have a company that last valued their real estate 30 years ago. So obviously, there's some hidden value there. Thirdly, what's the value of the brand? So, which company has brand appeal? The Jamaican company has brand appeal overseas. And what's the value of that brand vis-a-vis the other assets in the company? So some things that you need to look for in determining the next Lascelles. But actually, when you look at the price to book, you see some themes emerging. You have some, for example, what I call the birthday Hathaways of Jamaica, where they are investment holding companies. So, there are myriad of themes. And I want to mention theme because there are various ways to generate or create value in the Jamaican market. And that's what Jack Schwager did when he interviewed all these traders, because each trader used a different philosophy, investment philosophy to generate returns. So some things to think about. And one of the things that Mark said before, he spoke about compounding. Just want to add that Warren Buffett says compounding is the eighth wonder of the modern world. Something to think about also.
What did you say was the eighth wonder?
Compounding is the eighth wonder of the modern world.
Yeah, well, Mark gave us a really great graphic to show us how that works. After 50 years, they have how much? 17 billion? I don't remember, but it's a lot of money. All right, let's bring Chad back in. Chad, Christoph has a question for you. He says, do you have any recommendations for any steady US stocks to start out with and check out?
Yeah, so what the portfolio that we've been running all along is a rising dividend portfolio. So one should look at companies again that are increasing their dividend, but that's based off of that steady Eddie income stream or cash flow that's increasing for the corporation's operations. So for example, look at a company, consumer staple companies like Hormel, HRL, or look at a company like Hershey's, HSY. Those many investors will say are boring, but they have done quite well in this time of financial stress. And they've also increased their dividend considerably. Another company that we own, like Pepsi, for example, is another one that we like quite well. We've owned that for 5 years. It has had a tremendous amount of dividend growth, all three of these companies. And you can buy these companies and put them away. Even in a pandemic, you could feel secure knowing that they're not going to go out of business, that 5 years from now, like Mark said, you're going to get that compounding effect with the income stream and free cash flow stream.
All right, thanks for that, Chad. So I have, oh gosh, I have another question. So Rez, I recall earlier in the presentation, you made the claim that VM Wealth Management's research team is better than all the others. I want you to defend that for me now. Why is VM Wealth Management's research team better than the rest?
Okay, so let me drop it like this, right? No other investment house, with all due respect to my colleagues, would have a data going back to 1970 on the performance of all assets. I've never seen it on any presentation in Kingston. That's one. Secondly, right, and that's important because that will indicate to you how do you create value and sustain value over a period of time. So if you're running a unit trust fund or equity fund, you won't be phased by FinSac or the debt exchange, etc., because you know that true to your core, equities must be invested in equities. And actually, a lot of the pension funds that were started in the 70s are now, materially overfunded based on having been invested in equities. Secondly, the research team, we don't only read the annual reports, right, and write an analysis. We call the suppliers, we call the CEO, we go to AGMs, we're always tweaking our model. We have models for each company. So we can say, as driver X is changing, and we're aware of that change is input in our model for us to derive what we term as intrinsic value, and we compare that intrinsic value to market value. So, I do believe that we do a bit more fundamental analysis as compared to a lot of the other players.
Question for Mark. One of the biggest issues I get, so I talk to a lot of millennials like you do, and people are always saying, I'm sold. I want to do this. I really do, but I just don't have the money to start. How can a young person just starting out in life, how can we, and we don't have a lot of money to begin with, how can we get started, Mark?
Yeah, great question, Kali. As you said, it's something that we get on Twitter all the time, right? And I have a thread where I break it down in specific details, but I'll just kind of like bring out some highlights. So the way to kind of think about it is, in order to start investing, you want to kind of achieve some amount of, have a quote unquote lump sum to start with, right? So let's say that target is $5,000 Jamaican, 10,000, 15,000, right? You set out a modest target, and then you say, all right, realistically, every single month, what can I put aside? right? And it doesn't have to be a whole lot. It doesn't have to be, it can be as little as $50. It can be as little as $100, $200, whatever. But the key thing is to just develop the discipline to do it. And then once you make the decision that, okay, I'm going to do it, if you know that you have a weakness for spending, then what you want to do is that you want to set up some mechanism to force you that, okay, once you do it, you can't dip into it. So for example, one of the things that you could do, if you have somebody that you trust, that you're really, really good, friends with, or, that you're tight with and you really trust them, you can decide to give them the money that you save every month, and tell them to hold it for you in an envelope. Like you give them an envelope and you say, here's $200. And every single month you get the $200, you give it to them and make them hold it. And then that just grows, right? Until you get the 15 grand or the 10 grand, whatever your target was. And then once you get that, then you go to VM, or any other broker of your choice. And then you open up your brokerage account and then you start investing. So that's one way. Another way is, you could go to, let's say you don't have an account with VM. You could go to VM and you say, okay, I'm going to open a savings account. And every single month, what you do is that you don't get a card on the account. So you make it, and you also don't get online access. This is just initially, right? So you just open an account and you make it difficult for yourself to be able to withdraw money. And then every single month when you have, your $50 or $200 or your $500 or whatever it is, you take that money and you go and deposit it in VM. And that's it. All you do is just deposit the money and you just watch it grow. Just wait. Just keep depositing money until you get that $10,000 or that, $15,000. And then once you get that, $10,000 or $15,000, then you go and then you start your equities account and then you start, doing investing. But all of that time, one, you're kind of like teaching yourself the discipline to be able to actually save diligently. And then two, you take the time to learn about investing, to learn about the fundamentals, take some of my classes, for example, watch Money Mondays, watch Taking Stock, come on Finance with a JA, ask questions, interact with people, so you take that year or however long you need to learn so that when you start investing, you're not starting, completely from zero.
Khalila, can I
add? Sure. Go ahead, Rez.
So that's a very important question because a lot of us believe that we need a lot of money to start. So I gave the example of direct investments vis-a-vis a managed portfolio. So a unit trust is a managed portfolio at VM Wealth, or minimum for equity portfolio is 10,000 Jamaican dollars. The minimum for US equity portfolio is $500. So I just want to kind of put that out there. And then
$500 US.
500 US dollars, correct. And then, earlier, Mark did mention the nosebleed savings rate. That doesn't apply to VM, Mark. That applies to the other organization. The VM base savings rate are the best on the rock. So I just want to put that out there.
Which is what? You can't put it out there and tell us what it is.
We're the best. For example, we have a deferred share offer, which is north of 5%, which is an excellent rate. That's on the VM base side, not on VM Wealth. So I want to kind of leave that there. Person who are interested can call VM base tomorrow morning.
Awesome stuff. And let me just add to what Mark was saying as well, in terms of, this is what I often tell people when they ask me, how do I start? Easiest way, salary deduction. Go to your HR department, your boss or whoever, and just have them take that money straight out of your salary every month and put it directly into an investment account, such as one that VM Wealth Management offers. And you won't even miss that money because you learn to live without it. So whatever comes to you is what you live off, and that money goes to your investment account so that when opportunities arise for you to invest, the money is there for you to tap. I was telling you guys earlier that I'm reading The Richest Man in Babylon today, and gems upon gems upon gems. This very question answered in that book as well. So the richest man is telling his students in the group that your expenses will always rise to meet your income. Your expenses will always rise to meet your income. So no matter how much money you make, you will always find a way to consume all the money that you make, unless you pay yourself first and you put your money for saving and investment aside first. Take that out first. And to me, the easiest way I find to do that is salary deduction. Yeah. So we're going to have to leave it there. Really want to thank everybody for joining us. I hear over 1,000 people have been online with us tonight or this evening. Is it dark yet? I don't even know. I don't think so. The smoke is just messing things up. This Saharan dust, right? Before we go, let me tell you who the winner of our last question was. Let me find the answer. Let's see who was the winner.
Kalila, while you do that, can I just ask Chad one quick question before we go?
Sure, go ahead.
So Chad, in your presentation, you had said that for the fixed income portfolio, we should make sure that 10% of the fixed income assets expire every year. Can you just give us some an explanation why that is? Is it because the yield tends to be highest closest to expiration, or is it for cash flow purposes? Like what's the thinking behind that?
So, not knowing each person's financial plan, one should consider that they should diversify their portfolio on the fixed income side based off of cash flow. My recommendation for a retiree, for example, or someone that is nearing retirement or around 45, would be to take 10% and have that 10% expire every year from year 1 through 10. So that in this low interest rate environment, as rates gradually increase, and that's the hope over the next 3, 5, and 7 years, you as an investor will be able to allow the bond portfolio to expire at a rate of 10% and then invest into higher prevailing rates in year 10. It's general assumption that the bond market, the interest rates in the bond market will start to go higher, in particular in years 5 to 10 years out. That will give the investor more of an opportunity to gain cash flow over time. But remember, every investor is different, and we have to make sure that their cash flow needs are met in the highest quality fixed income instruments, in particular because of the financial stress we're under now.
Right, and that's where VM Wealth Management comes in for that personalized service, because as Chad said, every investor is indeed different. Your goals might be different than mine. Your timelines might be different than mine. You may be trying to invest for retirement. I might be trying to invest for my child's college fund, or because I want to buy a house next year. So our timelines are different, and that will impact what types of investments you decide to ultimately go with. So contact Victoria Mutual Wealth Management for your personalized advice. So the winner of our final question, question 4, is Alicia Timmel. Congratulations, Alicia. You have won yourself the gift of knowledge, one of the book giveaways. And that question was, how can an investor reduce risk in their stock portfolio? The answer is by using leverage, diversification. We spoke about that so much this evening, and also day trading. So this forum is only one part of the investment education activities at VM Wealth Management. The aim is to give you, the public, facts and insights that will guide your investment decisions. So materials sent directly to clients and anyone who requests these. So you don't have to be a client. See, we talked about that earlier too. If you request, or if you're a client, you can get this type of information. Active Investor, that's a daily review of the important happenings on the markets. That includes the JSE bonds, global bonds that Chad was talking about, as well as FX, foreign exchange, the daily rates. Money Moves is the weekly video series that VM Wealth Management has. It's an overview of the main local and international trends in the financial market. And they also have another one called Insights. That's their monthly newsletter. Interesting articles with relevant economic updates are in that. And you can subscribe by sending an email to the same address I've been mentioning all evening, wealthinfo@myvmgroup.com. That's wealthinfo@myvmgroup.com. Now, the following content guide to investing decisions is also available on VM Wealth Management's website. It's vmwealth.vmbs.com. That's the web address, vmwealth.vmbs.com. And that provides listed company analysis. So it gives you a detailed overview of the key performance indicators and business results for companies listed on the JSE. That, I tell you, is invaluable. They give you stock picks. So when people like me and Mark go on Twitter and say, don't ask me for investment advice, I'm not a licensed financial advisor, VM Wealth Management are, and they can actually give you stock picks. and they have a weekly selection of stocks to watch from their research analysis, the best team in the land according to Rez. And this list is anchored by detailed analysis of the market and company fundamentals. So I want to say thank you before we leave to our presenters, Resworth, Burchinson, Chad, Morganlander, and Mark Gale. You guys gave us a lot to think about. Thanks as well to Eziram for the live streaming services. Thanks to the team at VM Wealth Management for producing this program. And of course, look out for the next in the Wealth Talk series that comes up in July. My name's Kalila Reynolds. I can't leave without giving you a plug for my own stuff too. Just check me out on YouTube. I'm easy to find. And see you guys in July. Thanks, everybody.